All right, we are back. Welcome back to another exciting, entertaining, hopefully educational week of the Applied MMT live stream. I've got Adam back on the stream. Welcome, chat. I'd love to kick one of these things off with like oh man, markets are really going crazy, but I think we're at the exact same price we were during the last live stream, so not too much has changed. But what is of interest is we are post-op X in terms of the dealer hedging and what they have to do. So things might finally be happening here in markets where we get something exciting brewing up in the marketplace. But anyway, yeah, welcome to the show tonight. As I said last week, this is going to be probably the most informative hour of live stream that you'll watch until next week when you watch this again. And I promise you're going to learn a lot tonight. We have some really cool stuff that we're going to cover tonight. One of the things we did on Friday, Adam and I, we got together. Adam, by the way, how you doing tonight, man?
I'm doing well, Douglas. Good to be back.
Nice.
On the stream.
Nice. Vladimir,
Hello,
Jay,
chat.
welcome. Thanks for dropping in and saying hi. I see some likes coming on into you. Always appreciated. One of the things we did Friday night, Adam and I, we hung out and we did like a code jam session, and it was really informative. It was informative to me. Maybe it wasn't informative to Adam. I think maybe he already knew it all.
No. It was very cool. Not the most exciting Friday night, but it was very. It was cool. Big time.
So anyway, I taught him a little Python, which he's getting off the ground on. And then one of the things we did is we talked about the business cycle and some elements of the business cycle for what we're trying to figure out to correlate it with taxes. This is going to sound beyond dull, but I promise it's really cool when it's all said and done. So we're trying to correlate a way to essentially like understand where we're at in the business cycle in real time as much as possible. If you've been watching the live stream over the last few weeks, you know that a handful of things, some of the things we've been talking about is kind of the credit cycle and the implication of the credit cycle on markets. And so, if we can follow that credit cycle, and I think those are essentially synonymous, the credit cycle with the business cycle. So if you can kind of understand where we're at real time in the credit cycle, then we can understand where we're at in the business cycle, then we can understand where we're at in markets. And the way to potentially get ahead of that is with tax receipts. And so we went over this both in theory and then how to pull all the data is what we did Friday night. Again, very fun stuff for Friday night. But it turned out kind of cool, and we actually ran across some things and found some correlations that I've never ran across. So we're going to kind of redo what we did Friday night, hopefully with a little bit more excitement. There's not going to be any more excitement, but it will be educational. It will be informative, and I think both you and I, Adam, when we were all said and done, ran across a few things that maybe we really hadn't seen before or understood before. So maybe chat was already aware of everything we're going to say tonight, and they are well aware of these correlations, but maybe not. Maybe you guys will learn something along the way. So anyway, I'm seeing viewers stroll on in. So if you are coming on in, make sure you hit that like button, and I'm sure you're subscribed at this point, so I won't mention to hit the subscribe button and turn the notification bell on. Other than that, Adam, what's on your radar? Anything good this week come up or?
Well, I am excited about the project we were working on. So I think just high level, maybe we give everyone the high level pitch of what the kind of the thinking behind it is. But basically the idea is that tax receipts, so government tax receipts, might be a leading indicator for what's going on in the rest of the economy, specifically the credit cycle. So we'll go into detail on that. I thought, Doug was kind of walking me through how to pull in all the treasury data, which is cool, and then how to manipulate that data. So it's something I'm excited to get into for sure. And I think you guys will find it interesting as well.
So one of the issues that I've ran into is how slow it is that the government reports a lot of the data. Oh, that's a good guess, Jay. More tax receipts, less credit. We'll find out. We'll find out. And there is a bit of a paradox with this in the sense of because I think your instinct is all of a sudden if taxes surge, that maybe could be bearish in a sense, right? That could actually constrict taxes, and there's like an element to that plays out. Well, yeah, one of the issues that you run into is the government is very slow to report data. And sometimes the U.S. is actually about as good as it gets with the daily Treasury statement. So what we were hoping is, can we use the daily Treasury statement, which has the tax data in it daily? Is there a way that we could engineer that in a manner that has some information in it that we could then feed to a deep learning model, or just feed to maybe even a more simple model, just to know, yeah, if there's anything there. But before we even take that step, we got to find out, is there anything in the tax data, and if there is, what is it telling us? And then if that's not there, then maybe you don't go down that path of pulling the data from the daily Treasury statement. But if it is there, then maybe it makes sense to take that next step. So, Adam, if I'm missing a piece, cut me off and make sure we're filling all.
Will do. No, I think you're good. You're good. I will though, if I catch anything.
So let's do this. I'm gonna switch over to. I just noticed I don't have my internet browser, my Chrome window ready to go, but now it is. So we're gonna switch over to total credit to the private non-financial sector. We've talked about this in the last three streams in terms of what change of credit does to markets. Just a quick summary. When credit is accelerating, expanding, that is telling us that effectively new money is being created and we're getting new flows of money into the private sector. That is that is the business cycle 101 from an endogenous standpoint. This is like what Steve Keen, his whole idea is when you look at endogenous money. When credit is accelerating, that is creating new money for the private sector. And the kind of core takeaway from that is that it's cyclical. From kind of the Steve Keen model is that it's inherently cyclical. There will always be a boom-bust cycle. And if you do a percent change from a year ago, so you're essentially seeing what would be the flow, right? The more cyclical side, the ebb and flow, and quite literally the flow of credit, so that year-over-year change, you can see that there's this credit cycle that takes place very predictably and very cyclically. Every handful of years, you get this boom bust, boom bust, boom bust. Starting in the kind of the great financialization of the private sector. From the 70s into the 80s, you get this boom bust into the 80s. You peak into 1980. You get the bust. You get the couple of recessions. You get this boom period in 85. This is the one anomaly. Now you do get this mini acceleration that then contracts and leads to the recession. And then, of course, in more modern times, you have the 1990 dot-com bubble boom, and then subsequent bust, and then the great financial crisis boom, and then this kind of mini boom that took place after the COVID era as well, that led to what I still kind of call this kind of stealth recession, where you had a collapse and a contraction of the credit cycle. So you can see this very clear credit cycle. The problem is number one, the reporting of the credit data, so the total credit to the private non-financial sector, which is going to be the largest capture of credit, gets reported quarterly and from the prior quarter. So at any given point, you're like 6.5, or no, you'd be like 6 to 8 months behind in terms of the data that's actually being presented in the data that you can see. And that's not. It's helpful for maybe confirming some theories that you might have, for building models that are going to more kind of confirm and help you understand the dynamics that are at play underneath the market, but it's not terribly helpful for building models that are going to be predictive, because we're sitting here March 18th and the most recent data we have would be from September 30th on something like the BIS data. And the BIS data, like I was saying, is the broadest capture of credit. You can add something like the H.8 credit data. So that's going to be bank credit to I'll put this on its own axis, even though it doesn't look like it needs it. So that's going to be bank credit, and we'll kind of cut it so both of these have the same time frame. So bank credit does give us a little bit more of a lead. In fact, it's only, I think you're about 3 weeks to a month behind in terms of the delay. But there are some, I don't want to say anomalies, but there are some different ways that the bank credit that the commercial banks report every week. There's some ways that the bank credit can be a little bit misleading to the overall, I'm going to call this kind of endogeneity of the cycle. And the thought is, okay, is there a backdoor way that we can get the total credit in the financial sector, right? And can we get it in real time? And is there any way that we could see this or some implication of this in the daily treasury statement? And this is something that I've been scratching my head about for a while, and that I've really wanted to build. And it's just hard. None of this is easy. No one's exactly just said, yeah, this is exactly how it should be done, so go do it. And then you got to think, okay, well, where could we see this? What could be the implication of this? And this is where a firm and thorough understanding of MMT plus kind of a heterodox endogenous money cycle idea, that's where these things come together. So that is the problem we're trying to solve. And you guys already know where I'm going with this because I've talked about taxes. I think it's even in the thumbnail. The taxes might be it. But Adam, I'll bring you in here. You know, taxes is where I'm going to go with this, but why might taxes be what we want?
Yeah, so I had the same instinct as I don't know who the commenter was that said taxes would be bearish, but basically the way we're thinking about it is that tax collections happen, like as the economy is expanding generally. So employment taxes, sales taxes, all kinds of taxes come into play when economic activity is expanding. So we think that taxes are a leading indicator of bank credit because it indicates that the economy is expanding, and that thus bank credit is likely expanding as well. That's kind of our thinking on the tax side.
Yes, I was reading chat, but I think the second part was the thinking that we have, right? Okay. Yeah. So my thought was, if new loans are being created, that the purchase then of whatever asset that loan is obtaining, whether that asset is like the labor of employees or it's like a real asset, right? That there's some sort of tax receipt. That's it's the end of that, right? It's effectively the receipt of the transaction that takes place. And so my hope was that we could maybe see a correlation between tax receipts and the credit cycle. And we wouldn't be doing this stream if the correlation wasn't there. So I'll switch to it, and kind of lo and behold, that's exactly what you end up seeing. So overlaid here is the federal government current tax receipts, and what I can do actually here is I'll pull this up first, and we can just look at this in and of itself. And here's the rise of tax receipts over the years. What's kind of wild to me is I had to double check this. I'm sitting here talking to Adam on Friday night. I'm like, did we really receive in quarter 3 2023 $2.8 trillion worth of taxes? I mean, that's just a lot of taxes. And it's like, yeah, that actually kind of makes sense. I mean, the government spends a lot and it taxes a lot, and there's a lot of money that is flowing through the system at any given time. But here is, again, this is the tax receipts for each quarter. So if we do a percent change year over year on this and overlay that with the change of credit year over year, you end up getting a pretty strong correlation here. I could run all the fancy kind of causal tests that I like to run, Granger cause, CCM, and whatnot. We could even run your classic Pearson correlation, but I don't need to. I mean, I can, but at this point I don't need to, because the logic makes sense in and of itself, right? And the logic kind of confirms what it is that we'd be expecting here, and that is that an expansion of the endogenous cycle would create an expansion of taxes as a result of that. And so yeah, it ends up being what it is that we kind of expect. And what's nice about this then is that we can start to dig into the data and kind of build from here and see if we can't grab anything out of this to build upon from a tax standpoint. So Adam, I don't know if any other thoughts to add on that or.
No, I think that was a great explanation. I think again though, like the key thing that we're trying to figure out, or the key thing that we think this model can do, is that the reporting on bank data is lagged, and we think we can get ahead of the reporting basically by looking at the tax receipt data. I think that's kind of the key.
Yes.
Yeah.
So, and again, going back to this too, the reason for this. The reasoning for this is to ultimately tie it back to the credit cycle. And what I'm going to show now, if you give me one more second here, maybe not, is, well, yeah, let's do this. I'm going to switch back to this screen. And I'm going to add I'm going to drop the tax data here real quick. So that'll be the blue line. And we're going to add a line. You know what I could have done? Yeah. I'm going to switch over. Guys, I'm sorry. I'm going to switch over to this, and I'm going to do Wilshire 5,000. Unfortunately, the S&P 500 cuts off starting like 2012 or something. So we got to go with the Wilshire, but it's close enough for what we're trying to do. We'll drop bank credit, H.8 bank credit. And so now you can see that there's an overlay here of the bank credit cycle and stocks. And again, this makes sense from an MMT perspective, from an endogenous money perspective, that you're going to have a correlation between these two. And some of the work that I have done, I haven't prepared for tonight, but if you go back and kind of watch the archives of videos that I have here and on Twitter, I've posted this before, but you can definitely detect using kind of causal inference tools that the credit cycle is the kind of forecastable, what's the word I'm looking for? The forecastable feature to the forecastable variable to stock prices. So again, this is building on straight up Steve Keen. I don't want to say 101, but maybe like 201, 301, higher level Steve Keen stuff. But asset prices undoubtedly are driven by an expansion of this endogenous cycle, and so there's this correlation. And so the thought is, if there's a correlation between taxes and the credit cycle, then there should be a very strong correlation. And there's a correlation between asset or equity prices and the credit cycle. There should also be a correlation between asset, equities, and taxes. And that is the final chart I'm going to show up or bring up right now. And that is, again, this year-over-year change, so the percent change of the Wilshire and the tax receipts in blue here. And lo and behold, you end up getting a very strong correlation. And this is actually just one of those things that I guess I kind of assumed in the back of my mind would undoubtedly be there if I ever looked it up, but we didn't. And this is one of the things we came to on Friday night that finally came to our attention, that there is this really strong correlation here. So my guess is, if I had to guess, you guys can come back in a couple months here and call me out if I'm wrong. But my guess is we're going to see a very quick resumption here in tax receipts, because we've been seeing stocks go up, which means those tax receipts are coming from a resumption of the credit cycle. And that is exactly what we were expecting at the end of 2022 into 2023 and now into 2024, is that we've been seeing this kind of reacceleration of the credit cycle. And so what I think this does, and by all means, Adam, fill in anything here. What I think this does, I think this brings us from like baseline theory into this kind of feature engineering and proving that, okay, we can forecast equity prices based on the theory of MMT, and if we can engineer the data correctly, we can actually build up models that are truly predictive going forward from here and add alpha to our to the way that we ultimately invest in markets. I'm gonna read chat. Give me your thoughts on that.
You asking me or you asking chat, Doug?
I'm asking you and chat.
Okay.
Chat, yeah.
Yeah. No, I think it's kind of like another data point that makes total sense when you think about it through the MMT perspective, right? It's like what are more tax receipts telling us, and what can we expect based on the fact that more tax receipts are out there. And I think that, like, I'm sure other people probably get that, but I think MMT kind of puts it all together like that. The framework, I think, puts it all together. And I'm excited to see what we can do with the models and the predictive side, because that will be really exciting. So I'm looking forward to working on that.
Yes. So, a couple questions. If so, is federal expansion leading to expansion of credit? Yeah, I actually do think so. I think that is kind of how it has to happen from a logical standpoint. So, as I see it, and this part, I think, one second, I have a special guest off camera. Good night, kiddo. As I see it, when the government spends, and I say this, and what I mean by that, this will fill in what I usually say, is it's capitalizing the private sector, right? And so what I mean by that is it's the private sector grows through credit expansion, right? As much as like I champion MMT and the ability for the government to create money without financial constraint and like that whole narrative. What really is driving the economy, what we see as economic expansion, is the expansion not of the fiscal side per se. It's a necessary expansion, but what we usually understand is the expansion of the economy is the private sector expansion, and that happens through this endogenous money creation, and that endogenous expansion can really only sustain if there is that fiscal flow always feeding into that. And so the first part of this is the banks just quite literally need to get capitalized. They need bank capital, and bank capital is fiscal spending that hasn't been taxed back yet, right? Like that's the necessary first step. So that's one way bank spending capital or fiscal spending capitalizes the private sector. The second way, and why I use the private sector as a whole here, the second way is it's creating new income for the private sector to have income to be eligible for a loan in the first place. So if there's no income for anyone, then banks can't make loans. That's the first. That's like the most important. That's the most important piece to this, is that there's income for loans to be created, and that's it's again really the only financial constraint to the private sector expanding is this income side. So yeah, when the government spends, it is creating the necessary environment for that private sector expansion to actually end up taking place. And that is why, yeah, if so, federal fiscal expansion is leading to credit expansion, necessarily so. That is how it has to happen. So, good question,
Doug. Do you mind? I just want to piggyback on that. Do you mind pulling up the graph of credit expansion on Fred?
Yeah, just the main one.
Yeah, just the private sector credit expansion. I just want to point something out.
Year over year? Or,
yeah.
Okay.
Yeah, the one that shows the acceleration.
Yeah.
Yep. So let's see here. Can you change it to?
You know what? This is not the right graph.
Yeah.
Sorry.
Not the right one. That's right.
This is the right one.
Yep.
Let me delete the Wilshire from this. All right, go for it.
Yeah, so I wanted to what I wanted to point out here. Can you expand it back, Doug, just so it's the whole time frame? Yep. So Doug called this out earlier, but basically you can see on this graph that every time private credit starts to decelerate, we get a recession. So the gray bars are the recession. Except in this most recent period, and we did get what Doug calls the stealth recession, but there was not like a technical recession, which is why it's not grayed out in the chart. And what Doug and I were talking about the other night on this is that the difference when we did have the deceleration here in private credit is that balance sheets were strong enough to deal with that because there was so much fiscal support coming from the government. So the rate hikes were part of that because interest payments went from like 500 billion annualized to 1.2 trillion annualized. But the government deficit was, we're still running a very high deficit, and that provides the necessary income to support the economy, even if private credit is decelerating.
Yes. That is really important. I've tried to drive home this point many, many times in various debates with people regarding, the interest rate causing a collapse and that sort of thing, and why didn't we ever get a collapse? Usually in every time period. I mean, I could just add this, right? I'll just add the Fed funds, right? Well, we probably don't want to do percent change from here. Go. We'll zoom on in post 1970 here. One thing, everything we're saying is true before the 1970s, but we had such an expansion of the financial sector and such deregulation that took place from the 1970s forward that there are some qualifiers that you have to understand if you're going to make kind of MMT analysis pre 1970s because of that. So sometimes the correlations break down. It's not that the analysis is not true back then. It just takes more qualifiers. So I like to zoom in post 1970. So anyway, really strong correlation here between the Fed funds rate and total credit, and this is why every time we get this contraction of credit, that we get such bad recessions that come of it, is because the Fed is taking away the one thing that is really needed right at that point, right? So there is, and again, this is hard sometimes, I think, too, even for kind of like MMTers to understand, is no matter what the government does, and they can always step in. There's never a financial crisis large enough that the government can't step in and take care of, but there is still will always be an inherent cyclical nature to the business cycle. It just has to be there as part of the very nature of the business cycle. And the Fed, being the monopoly price setter of interest rates, they're looking out, and they don't know they're the monopoly price setter of interest rates, but they're looking out at the marketplace, and then all of a sudden they see the market signal saying, hey, we're kind of getting a little bit of a slowdown here, right? I jacked up rates, and then the cycle of the market does its own thing. It always booms and busts, and if you take it back to the beginning of time, it's always booming and busting at a very predictable cyclical rate because that's just how it works. Which again, if you want to go more into the math, more into the understanding of this, Steve Keen, look up Steve Keen, Minsky at 100. It is a great 1-hour summary of everything Steve Keen has ever said on the topic. It is inherently cyclical, and so you're going to get this boom and bust cycle. And so there's an inevitable contraction of the boom, and that's why the boom has to happen first, right? The boom has to be there. That's why we never got a major recession from 2008 until COVID, because rates were at zero, and low rates don't set the stage for a boom. High rates set the stage for a boom. We never got the necessary juice to get the boom. But when you get the boom, the other side of the boom is the bust. And the Fed senses that because the market data that's coming back to it is, okay, we're getting a little bit of a tightness in employment. Growth isn't maybe moving as fast, right? We're getting this slowdown. And they push the brakes on rates. So they think that the market is telling them to do something, when in reality, like, they don't need to be looking at the market at all. And so it becomes a self-fulfilling prophecy from the Fed's perspective. They go ahead and push rates lower, and that just collapses the business cycle at that point. And they do this every time, going back as far as effectively you can reach on this, up until 2022, when we had this transitory inflation that was going on because of all the reasons that we're aware of, and you had this big surge in inflation that was at the forefront of what the Fed was trying to fight. The inflation was, their existential risk. And so had they done what they always were supposed to do, we would likely be in a recession right now, right? If the Fed actually dropped interest rates to zero following the business cycle signal as their primary signal, we'd be in a recession. But instead they did the opposite, which is why we knew that we were not going to get a recession in 2023, that we were going to get a surprise growth to the upside, because they did the opposite of what they normally do. All that to say, I think there was a point you made about 5 minutes ago before I started my monologue here. All that to say that yes, it's important to note that it was the fiscal that offset the 2022 contraction because the Fed hiked rates, which means more government spending because of interest income, which ultimately supported the market here, and as opposed to a contraction, and why we're in the place that we're in. I think it's just fascinatingly instructive, personally, to see this and then understand it from this combination of MMT and kind of this endogenous money idea. It really explains it far more elegantly than anyone else. I mean, it's actually the only explanation. And the other thing, I'll stop patting myself on the back. But
I'm curious to know. I don't even know what the mainstream explanation is at this point. I don't know if it's Taylor Swift. I don't know if it's because, that's the mainstream is saying that the economy is being propelled by Taylor Swift, or if it's the expectations that rates are going to be cut. Like, I don't even know what the official narrative is on, why there was no recession anymore.
It's a really good question. That is a great Twitter question as we enter Q2 by I think everyone said without a doubt Q2 2024 we'd have a recession. So that'll be maybe the question I ask, like how come?
Yeah.
What did you get wrong? That is really the question I want to ask so often on Twitter. Like
it feels this is my experience, but it does kind of feel like that once the calendar rolled over, once we got into 24, everyone just stopped talking about the recession that we were definitely going to have, and it just became everyone kind of forgot about it. The mood seems to have shifted post 2023
to now. When is this bubble finally going to end, sort of thing?
Which I don't even know. Now it just feels like everyone's like, okay, I guess the world isn't collapsing and everything's gonna be fine.
Yeah.
There's always the bubble. There's always the bubble people, but I'm saying like the people that were in the recession camp but aren't the perma bear types are now looking at the economy and they're like, all right, maybe everything's fine.
It would be a good question. I know what's his face. There's I forget his name. Gosh. I wish I could think of it right now. There are a handful of them that I know got it wrong and are trying to figure it out. Like admittedly trying to figure it out. Why do they get it wrong? I mean, they'll never accept why it is that they got it wrong. But there are a few honest ones. Some of, I mean, obviously the less than intellectually honest are just like, yeah, whatever. I'll move on to the next thing. And there's this cycle that I see take place around this where you see a call made. I mean, I've been around this game for long enough now. They make the call. The call inevitably turns out against them in some way that they can't quite explain. And even the more intellectually honest ones then have to, like, for at least a month or two, divert to just kind of blaming the government in some general way, right? and then the cycle starts back up again. Like, okay, I've cleansed my palate of being wrong here. Like the government did something dangerous, and so now I can get back to just making my next call, and then the cycle will repeat, right? Like inevitably the call will go against them, and then it's somehow, and they're not even necessarily like the Austrian types. It's just today I'm going to give political commentary for the next 2 months because my or broader economic commentary, right? Like
right.
We should have been in yeah, go ahead.
It's fine. And I mean, I know we've talked about this a million times, but in addition to all the recession calls being wrong, it's like you also had the whole, oh, NFTs are a zero interest rate thing, and crypto is a zero interest rate thing, and now rates are 5.5%, and all these quote unquote assets are doing so well. And I don't what does the narrative say on that? What does the narrative say about crypto now and about NFTs? And if 6 months ago all that stuff was just zero interest rate phenomenon, what are they saying about it today? I haven't even heard any takes on why it's trying to explain that, like those bubbles. I'm curious to see what emerges.
It is interesting to try and put myself, I mean, one of the things I'll try and do is just a thought experiment, is put myself back into the position I used to be into years ago when I was kind of a hard money type, and try and think through what I would come up with. It's hard at this point, obviously. I mean, I know what I know. But going back to that, actually, I think, is the second week of the Brett Scott interview up yet? Did we launch that, or is that coming out this week?
No, it's a week from tomorrow.
A week from tomorrow, the part 2 will come out, right?
Yeah.
So I don't know what part this was in, but it's a great podcast worth listening to. But he really hit the nail on the head when he was just talking about the difference between having a mind kind of prepped for credit money and having a mind that is just stuck in a commodity
I think that's part 2.
Okay,
that'll be next week. Yeah.
And he's just it's just right. And part of and they can't escape that. Like, even the smartest people that are out there that are so close, they cannot escape that mindset, and they can just not grasp what kind of MMT and the heterodox schools are trying to say. I've been listening to a few of the shorts that Steve Keen has been putting up with his interview with George Gammon, I think is his last name. And and it's fascinating to see Steve Keen just go through kind of the basics of monetary policy. And he can repeat it, George Gammon, who's like an Austrian gold bug type. He can repeat it.
Yeah.
Right. He can kind of almost appreciate it, but then it stops because in his mind, it has to go back to some sort of commodity money, right? There has to be something, quote unquote, real behind the last curtain, right? Something has to, whatever analogy you want, something has to be there at the end. And like Lynn Alden is another one. I mean, they will say things from step 2 through 10 that are all MMT, like MMTers could absolutely agree with. But step 1 to 2 is some sort of real hard money. Like, they just cannot grasp that credit money is actually a thing. And therefore it completely breaks down. If you can't make the mental jump to credit money, if that's just if you're gonna break there, you will never understand a systems dynamics approach to economics. You will never understand what it is that it'll never click for you, because your system will never start with balance sheet operations where our system does.
Yeah, that is, and it's interesting. I like, when we were talking to Brett, he basically, like, the context of what Doug just mentioned, that crypto is appealing to people because, like, kind of the default position that people have in their heads, they think about money as just like a commodity, right? Like, the dollar bills in your pocket are a commodity. There's not an asset side and a liability side, and crypto plays into that. And that's why, like, I think that's why, people tend to understand it, and in my opinion, they're wrong about it. But it plays into kind of like just the common sense way of thinking about the monetary system. So yeah, excited to release that episode. I could release it tomorrow. I could just publish it tomorrow, or we could wait a week. I think we'll stick to a week from tomorrow, though.
Publish it. No. All right. So to culminate this tax stuff, one of the things that we track and data that is available over at AppliedMMT.com is the daily treasury statement data that just kind of has been given the moniker, do it, publish it. I like it. Larry Summers, you're back on my good side. No, we'll wait. It's worth the wait. Some of the data that we do publish over on the AppliedMMT site is the daily Treasury statement, and I really like the 90-day average of what I call net flows. So this is just going to be withdrawals minus deposits, and then the separate line here just kind of smooth that just shows the better, just kind of like the better arc of where flows are headed. And you can see, I mean, it's not a one-to-one correlation, but you can certainly see that there's a bit of a correlation here between flows, even on the short run, between flows and stocks, and certainly in a more fiscally dominated world, what you're going to see. So I'm thinking post 2020 after, you're going to see an even stronger correlation between stocks and flows when the growth isn't necessarily as reliant on that endogenous bank cycle. But part of this tool is you can actually break it down between just total net withdrawals, right? So that it's total government spending and total deposits. And so if I just go ahead and take off net flows, the 90-day average in the smooth line, and just add in net deposits are effectively like 95% tax deposits, right? So the government does receive some deposits like USPS or NASA or something like that, right? They might sell some services, like agriculture, I know, pulls in some money, but you get it. I mean, there's some revenue sources that come in to the federal government. The vast majority of deposits, so receipts for the government, are going to be via taxes. And so that's effectively what you're looking at here now in red. I didn't mean to do that. What I really want to hone in on is this big surge that took place in heading into 2008. What's kind of interesting here is, and this is where things like bracket creep, bracket creep, where a lot of danger can come in for instability for the markets when the government starts taking in a lot of taxes suddenly. And it kind of becomes an inevitability because of the fact that tax receipts are tied to the endogenous cycle, that you get this big acceleration. And what we were talking about, and why I really kind of wanted to pref that whole discussion earlier about the endogenous cycle being inherently cyclical and the fact that it will boom, is during the boom phase, that's creating more taxes. Taxes are a sign, higher taxes are a sign that the boom is accelerating even faster, right? So we talked about acceleration being a problem in and of itself. Really high acceleration, maybe amplifying the potential issue. It's also increasing the tax receipts that the government's getting, which means that's offsetting the government spending that could be coming out at that exact same time. And so where you have to be very careful at is when you get a sudden large acceleration in tax receipts, because that means that you're getting a massive acceleration in the credit cycle at that time, which is the necessary precondition for the bust. That's the boom that sets the condition for the bust. And you're simultaneously draining the fiscal flow at that same time. And so if I turn back on the withdrawal here, you'll notice that, for the vast majority of the time between the post-Great Financial Crisis up until today, there's always been a nice strong gap between the withdrawals, so what the government's spending and what the government's bringing in. But the gap closes right before 2008, right? So there is this, if the government is asleep at the wheel, so to speak, and they don't understand the dynamic, which they don't. I mean, they don't get it. They don't get the dynamics. This will set up the conditions necessary for a massive recession, and it's that last big surge higher that will create the recession. And it was right after tax season in 2008 that crap hit the fan, as they say, and we were contracting after that point in terms of growth, and then ultimately hitting the recession right at that point. So that is worth watching. The other time that we got negative and we saw the red line overlap the purple line here, so the receipts overlapping the withdrawals, That was 2022. Again, massive tax drain going on there that was both because of a sudden acceleration in bank credit that took place at that time. We showed that back in this chart right here. So 2022, strong acceleration, also causing those tax receipts to hit. Now we had strong government spending, but the tax receipt was the largest that we had ever received at that point.
I think, Doug, wasn't it also capital gains in that period?
2022, we had a lot hit.
Yeah,
we had essentially a 2-year moratorium on taxes at that point, if I'm not mistaken.
Right.
Yeah. So again, a perfect storm. But the big difference is, again, going back to this zero interest rate hit by the beginning of 2008. We were quickly to a 5% interest rate, adding additional interest income that effectively floated the market for the contraction and immediately started the acceleration once again of spending. So keep an eye on the tax receipts. They tell you a lot. They tell you a lot. And something we're going to continue to build upon. The tax receipts are part of Deep MMT, but the hope is that we can engineer this feature even better, right? Effectively, I think Deep MMT just has this chart where the federal government current tax receipts, the change year over year, what I just showed. So I mean, it has it's learning the underlying function at play, and so it can extrapolate that out in time. Our hope is we can create something that is even more granular for the deep learning model to feed off of, and get even more precise with its predictions. I think again, I mean, part of the reason I want to do this tonight, and hopefully this is instructive in the live stream, and let me know in the comments and chat and whatnot if it is, but. Part of the reason why I want to walk through this is so everyone's aware of how we're building the tools that we're building, and then also that this really does check out when you look at the data, right? Like the MMT heterodox framework really does check out as well. That it's not just lines on a chart like, hey, look, these kind of correlate. Like, no, the theory. You lay your theory out, you lay your hypothesis out, you then go find the data, and the data always confirms to what you think. That's like how it continues to play out. Is this data is confirming exactly what you would expect from an applied MMT perspective. So, yeah, hopefully it's helpful, and we'll kind of keep going down this path. Any other thoughts on this, Adam?
Not from my end. Would love to hear what you guys are thinking about in chat.
Yeah, if you have any questions, drop them in chat. I did see one up here that I wanted to get to, and that was, may I ask, if we assume this is to be predictive of the stock market, is there a risk in the predictive model versus the passive S&P fund Boglehead style investing? I'm going to guess that this is kind of a comment in line with, is it Mike Green? Is that his last name?
I think so, yeah. And Ryan has actually talked about this too. I don't entirely follow this whole argument. It's something I want to read more about. I don't know, Doug, are you familiar with it?
Yeah. I think the general idea is at one point everyone will become passive, or enough people will become passive, and the risk is that if everyone is passive, then kind of the algorithm to determine price is just, if I have income, then invest this income indiscriminate of where markets are at, right? That there's no discretion in terms of buying Coke over Pepsi, or buying large caps over small caps, buying domestic over international, right? There's no discretion there. And that part of that discretion that takes place when a money manager is making those decisions is that it's giving the market signal, right?
Right.
It's providing the signal necessary for price discovery. I don't even disagree that could potentially. That's a good comment, Vladimir. Financial asset inflation. How can we measure it? By being long the S&P 500. That's how we can measure it. I'm in agreement with, I think, the underlying theory that you need some sort of price signal, and that's like a good thing for market discovery and price discovery. The question is, will it ever be the snake eating its tail thing? Will it ever be, whatever, draw your own conclusion for how bad it could get? To a certain extent, yeah, I almost actually think that we see this, we've actually kind of seen this play out in short order in early 2021, and we might actually be seeing it play out again, where there's just so much hitting from the flow standpoint, and it's being so much like indiscriminately invested that you see these kind of gamma squeezes take place through just sudden pops in price that are just irrational in individual names. And maybe that is an expression of a little bit of this chaos entering into the system, where you get these these shots higher that take place. But yeah, I don't know long term though. I wonder if we can ever get Mike Green on the podcast and have like
I think I'm pretty sure Ryan reached out to him at one point,
okay.
and he said he's willing to do it. So yeah, I would love to have him on.
I would like to be able to pick his brain, and then if he was up for it too, have a spirited debate maybe if we end up disagreeing for the benefit of listeners. Yeah, because maybe there is a tipping point where that becomes problematic, and the question would be, though, it seems like it would be problematic to the upside, right? Like, and then I think the risk would be everyone trying to get out at the same time.
Right.
Like that's when that's when the discretion finally hits.
Right.
So yeah, good question though, Jay. I mean, it's a good hypothesis. It's a good theory that is worth thinking through. Let's see. Any other questions tonight? I think I've covered everything I wanted to cover tonight. Adam, you have any other thoughts before we get wrapping up here soon?
I don't. Not right now.
Okay.
Thank you guys for joining, as always.
Yes. Seeing nothing else in chat, guys. I think we might call it a stream tonight. And let me know down in the comment section, too, if there's anything you want me to cover next week. We can certainly divert from kind of our current path and cover anything else that might be up. Did you guys have a take on the idea that raising rates, that rates might rise, maybe? Is that the question? I do have a take. You're talking about the cause of rates getting hiked and the loss of the bond portfolio on the banks. So, I mean, undoubtedly that'll that hurts the banks' balance sheets when that contracts to a certain extent. Banks, however, have to be hedged for interest rates going higher, and I know one of the assessments that regulators use is called this thing called CAMELS, and the S, it's an acronym, and the S stands for sensitivity to interest rates. And so banks have to have some form of hedging to the exposure of their bond portfolio, so the Fed can in fact raise rates. So I mean, the Fed is aware of this and knows kind of how fast and hard banks could absorb the rise in interest rates. So as far as I'm aware, it doesn't affect banks all that much for the Fed to hike rates at that point.
Yeah, we talked to Mosler about this on the podcast. If you guys want to listen, I think I can tell you the episode number. It's either number 11 or 12 of the AppliedMMT podcast, if you guys want to check it out.
I like this last question, Jay. Why does Bob Murphy annoy me on Twitter, but not on his podcast? I like Bob. Hopefully he'll have me back on next June or whenever we talked last, so I can take my victory lap.
Everyone's more annoying on Twitter.
Yeah. The link. What episode did you say that was?
It's either 11 or 12. Let me see. I think it's number 11. I will send the link to you, Doug.
Was this the podcast?
This is the podcast, yeah.
Okay. I just, guys, if you go to podcast.appliedmmt.com.
Yep. It's number 11.
11 and 12 are the two Mosler interviews. All righty. One other thing I did have up, which I guess we can call out for the end of, does Doug make it to MMT meetups? Doug is currently in the process of purchasing that private jet to get me out to the MMT meetups. I don't know how kosher private jets are in the MMT world, but if it'll make me to the MMT meetups. No, I am in central mid Michigan, so quite the distance from the MMT meetups. Maybe one of these days, though.
One day.
Maybe I can when we all get to wearing the Apple VR headset. You guys can all be physically in the same space, and then I'll join you virtually. That just sounds dumb. Actually, now that I think about it, I'll fly out there. I'll say this too, just to finish off. The economic calendar bringing this up. Wednesday is the FOMC day, and this will be important here. We had all the financial data came out in the past week following our live stream. Again, all hotter than expected stuff. Hotter than mainstream expected, right in line with kind of where we thought it would be. And we are almost 100% for no rate hikes for March. And remember, going all the way back at the start of the year, our big thing was the race to March, and here we are come March, and no rate cuts in sight. May, almost 100% as well. What's really interesting, too, is June is now effectively at 50-50. So very quickly, everyone is realizing what we've known all along, and that is there ain't no way the Fed is going to get a cut in anytime soon, given where we're at. So I will, I'll finish on that thought. Not seeing any other questions. I think we will call it a live stream tonight. So thanks again, everyone, for joining us. And until next time, good trading, and we'll see you then. Bye-bye.